Hi, I'm Batu from freefincal, and today let's talk about why it's so much better to chase after returns in equity than to chase after returns in the fixed income or the debt space. In the morning, I had published a post on the PMC Bank Fraud written by R. Srivatsan. He is a regular writer for freefincal, and on this is about the Punjab and Maharashtra Cooperative Bank. On September 24th, 2019, the bank was restricted by RBI. It came under its directions, which means that there was a withdrawal limit set for depositors. It was only 1,000 rupees, and compared to a debt mutual fund, this is dramatic. Imagine telling you suddenly that you can't withdraw more than 1,000 rupees from your bank. And then there were a lot of reasons thrown around for this. They said they had created fraudulent accounts to hide NPAs from the regulators. The amount hidden was about 4,355 crores. Then there was a lot of protests, and then that was increased to 25,000 rupees. The withdrawal limit was increased to 25,000 rupees on October 3rd, 2019. And then on further protests, I think the finance minister had intervened, and then the RBI had increased it further to 40,000 rupees on October 14th. Then the bank currently says that the because of this increase in 40,000 rupees, almost 77% of the depositors in the bank will be able to completely pull out their money. The sad news is that as an aftermath of all these developments, five people have died, and in particular, Srivatsan had focused on Sanjay Gulati, who's a ex Jet Airways employee, and their family had 90 lakh in deposits with the PMC Bank, and he died due to heart failure after participating in a protest. And as I wrote this post, just today I saw. So this is, first of all, this is the news about the Jet Airways employee. All the links are there in the article. You can go look at it. And today I saw this. This is a woman, a 73-year-old woman who also died of heart failure, and their family had 2.5 crores in that bank. Oh my God. So Srivatsan talks about personal finance requirements to handle such problems. Extreme, I mean, these kind of situations are rather, you might say the the mathematical risk associated with it is rather remote, but then they do happen. Even if the probability is 0.0001%, but it's still non-zero. And if it does happen, it affects you in a great way. So Srivatsan does talks nicely about what are the basics that have to be in place to handle this and so on. Please have a look at his article. I would like to focus on a slightly different aspect of this, and that has to do with risk premium. So there is a very important idea in finance that's called risk premium. This means that if you take risk, then you must be awarded a premium, or at the very least, you should expect a premium. So, but that is the reason why, I mean, if you take risk in equity, you expect it to outperform over the long term, because businesses they are borrowing money at a rate close to inflation or a little bit above that, so their profit should be above inflation. And therefore, if you participate in the business, if you're an equity holder, if you have a stake in the business, then your profits should also reflect that return above inflation. But it need not always do it. That's the risk, but that's the risk idea of a risk premium. Now, risk premium cuts both ways. If you take risk, you expect a premium. You may not always get it, but risk is guaranteed, returns are not. On the other hand, if you don't take risk, you you must also pay a premium in terms of getting a return after tax which is below inflation. This is something many people simply fail to understand. They believe bank deposits are safer than the stock market. Well, that's a very relative statement. If you say, I mean, if there's a bank which is so we have, according to the government, our inflation is currently about 4% or so. If a bank is offering a deposit which is like 1.5% above inflation rate, then it means it can the way you should look at it is the bank can afford to do that. They are so well established, they have a client base or a customer base which is big enough that they don't have to go out there and say, I'm going to give you a 9% FD return. They're okay with 6.5%, 6%, which means that in order for them, in order for the bank to get a profit, they don't need to lend out money to other people at very high rates. So they don't need to take too much risk because they're not offering too much returns to you. They don't have to take too much risk. On the other hand, if a bank is offering 9% return to you, imagine for the bank to get profits, how much returns it should get from its FDs. Of course, FD is not the only business, but it's a major share of the pie. So it must go out and seek out borrowers who would be willing to get money at a 11%, 12%, 15% kind of interest, which means that the problem is if the interest rate is so high, they may not give back that money, and if they don't give back that money, the bank cannot give you back your money or pay you interest. So it's a vicious cycle, and people simply fail to understand that chasing after that extra 0.5% or extra 1% is, and putting so much money in a single entity is enormously risky. They will say, oh, stock market is risky, I'm getting guaranteed returns. The problem in the debt space is the risk is not visible until it hits you. In the equity space, the risk is daily visible. You see a ticker, you can see the price moving up and down, up and down, up and down. Everybody is talking about it. There are every day you go and type Sensex, there will be a group of people looking up like that or looking down like this. They'll tell you so much money has gained, so much money has lost. You perceive that risk. Whereas in an FD, until there is bad news, you don't know that there is risk or not. This is the problem. And of course, there is risk, and you can see it, that the extra yield. So if a guy says, so you have a SBI, ICICI, HDFC, these are the three biggest banks in India. And if any bank says, I can give you more than 1% more than their FD rates, or 1.5%, 2% more, something is wrong. That means there is a risk associated with it. And by putting so much money there, you're basically putting all the eggs in the same basket. That is the risk premium there is kind of, the problem is that you will get a premium, but the risk is so high, and the risk premium is not worth it, in my opinion. That's what I'm trying to say. A debt mutual fund is so much better than putting your money into cooperative banks. I see so many people chasing after, can I put money in Payments Bank? Can I put money in the small finance bank? Can I put money? Please don't do that. Stay, if you have only, my suggestion is very simple. For long term, you use PPF, etc., etc. But if you want safety, first, the number one safe fixed deposits in India are the post office deposits. They are out of purview of this 1 lakh. They have sovereign guarantee, and they will the entire money is insured. So that's the topmost. The second tier comes in terms of fixed deposits, ICICI, SBI, HDFC. Even RBI has gone on record saying that they're kind of too big to fail, and there will be a bailout and so on. Of course, the bank, RBI or the government will not allow any bank to outwardly fail. It will kind of make a merger and so on. But there is so much of problems there's so much tension that you have to go through. Is it worth it? It's like the people saying in equity, in the end it will become all right. What nonsense! People are going through so much stress. Tomorrow you go and tell them everything will be okay, sir. The government will merge your PMC bank with some other bank. Everything will be okay. Your money will come back. But when? That's the problem. A debt mutual fund which has got a large AUM and which just buys many securities. Don't go for small AUM debt funds. Go for a large AUM debt funds with a lot of securities. I've talked about this several times before. For example, an ultra short-term fund or a liquid fund. When there are large securities, I told you, I had mentioned this in the NPS video. I said, if you look at the NPS what is that? The bond portfolio of the NPS, it is 10 pages long, 10 PDF pages long, because there are so many bonds. Each of them is like 0.01%, 0.02%, that kind of thing. Even if that fails, nothing will happen to you. You will not even see it. It will be a small blip in the nav. You won't even notice it. So that kind of funds, if you go after, you are spreading the risk, and that is so much more safer than putting your money into bank FDs, thinking I will get return, I will get guaranteed returns, I will own like market linked instruments and so on. It's just complete nonsense. There's a lack of what can I say, knowledge in terms of understanding, I mean, risks and understanding risks premium. Um, so I lost my train of thought here. So that's what I wanted to say. Is there anything else I want to say? No. So please consider that. Don't. I mean, maybe many of you seeing this will not do it, but please don't allow anybody else chase after returns in FDs. It's extremely dangerous. Debt funds properly chosen are always so much more better. At the same time, don't assume gilt funds are better, because if you choose long-term gilt funds, you will lose your money. So there'll be fluctuations. So you have to understand risks and do everything together. Please look at Srivatsan's post. I'll catch you later. That's the reason why I said chasing after returns in equity, because it's a known devil, is so much better than chasing after returns in fixed income. At least market unlinked, fixed income not linked to the market. Bye bye.